Hello fellow traders. Today is another of many videos where we cover things in the markets. Today we cover oil futures versus oil sector ETFs by Pajama Trader. Let's get into it. In this presentation we will explore the decision-making process when trading oil futures and oil sector ETFs, taking into account the significant influence of geopolitical conflicts and wars on these markets. Geopolitical conflicts, particularly wars, have a profound impact on the oil industry, stock markets, and commodity futures as well. Understanding the dynamics of these tumultuous times is crucial for investors and traders. Today we'll delve into how wars affect oil supply and demand, creating stock market volatility and influence commodity futures trading. This knowledge will form the basis of our comparison of trading strategies in periods of peacetime and wartime, shedding light on unique challenges and the opportunities that arise. As we get into covering this market stuff with oil, ETFs, and oil futures, don't forget to like this video. Liking this video causes the algorithm to share this information for other people that are looking for information like this. So please, it's free. Don't hesitate to like. Let's continue. Oil futures are standardized financial contracts that obligate the buyer to purchase and the seller to sell specific quantities of crude oil at a predetermined price on a future delivery date. They are derivative contracts, which means that their value is derived from the underlying asset, in this case, crude oil. The key features of oil futures. Leverage. Oil futures typically offer significant leverage, allowing traders to control a large quantity of oil with a relatively small investment. This amplifies both potential profits and losses. Contract sizes. Oil future contracts come in different sizes, the most common being 1,000 barrels of oil. This means each contract represents 1,000 barrels of oil for delivery. Margin requirements. Traders are required to maintain a margin account to cover potential losses. Margin requirements can vary, and typically a fraction of the total contract value. Pros and cons of trading oil contracts. Pros. Leverage. The high leverage in oil futures can provide a potential for significant profits if market movements align with the trader's position. Hedging. Oil futures allow producers and consumers to hedge against the price fluctuations, reducing risk. Liquidity. The oil futures market is highly liquid, with active trading making it easier to enter and exit positions. Cons. High risk. The leverage in oil futures also magnifies potential losses, making it a high-risk endeavor. Complexity. Trading oil futures requires a deep understanding of the oil market and futures contracts, which can be complex for beginners. Margin calls. Significant price swings can lead to margin calls, requiring additional funds to cover potential losses. Physical delivery. If held until expiration, oil futures contracts may result in physical delivery, which can be challenging for traders who aren't prepared to handle or store the physical oil. Exploring oil ETFs. Definition of oil ETFs. Oil ETFs are exchange-traded funds designed to track the performance of a specific segment of the oil industry, such as oil producers, explorers, or oil services companies. They are traded on the stock exchanges, providing investors with the easy way to gain exposure to the oil sector without directly owning individual stocks. Key features of oil sector ETFs. Diversification. Oil sector ETFs typically hold a portfolio of various oil-related stocks, offering diversification within the sector. This helps spread risk and reduce exposure to the performance of any single company or a single company. Liquidity. Like individual stocks, oil sector ETFs are traded on the stock exchanges and are generally highly liquid. This means investors can easily buy and sell shares of prevailing market market prices. Expense ratios. Oil sector ETFs have an expense ratios that represent the annual cost of managing the fund. They tend to have lower expense ratios compared to actively managed funds, making them cost effective. Pros and cons of trading oil sector ETFs. Pros: diversification. Oil sector ETFs provide investors with diversified exposure to the oil industry, reducing the impact of poor performance in any single stock. Liquidity. As easily tradable assets, oil ETFs offer liquidity, allowing investors to enter or exit positions without difficulty. Lower cost. Oil sector ETFs typically have lower expense ratios compared to actively managed funds, making them cost-effective investment choices. Dividends. Some oil sector ETFs pay dividends, offering potential income to investors. Cons. Limited individual stock influence. Diversification, while a pro, can also be a con if an investor wants to focus on specific oil companies with strong growth potential. Market risk. Oil sector ETFs are still strong subject to the overall market fluctuations and can be influenced by factors beyond the control of the oil companies they track. Tracking error. This may be a slight discrepancy between the ETF's performance and the actual performance of the underlying index due to tracking errors. To recap, oil futures. Definition of oil futures are standardized financial contracts that obligate the buyer to purchase and the seller to sell a specific quantity of crude oil at a predetermined price on the future delivery date. Key features. Leverage. Allows control of large quantity of oil with a small initial investment. Contract sizes. Most common, 1,000 barrels per oil contract. Margin requirements. Traders must maintain a margin account to cover potential losses. Impact on wars and futures and oil ETFs. Wars and oil supply. Geopolitical conflicts and wars in oil-producing regions can disrupt the global oil supply. Supply disruptions can lead to increased demand for safe haven assets, causing oil prices to spike. Oil futures, being directly tied to oil prices, can experience significant volatility and price increases during wartime. Wars and market volatility. Wars can create uncertainty in financial markets, which can lead to increased volatility. High volatility in stock markets can influence the value of an oil sector ETF, causing prices to fluctuate. Investors may seek refuge in ETFs or commodities like oil futures during unstable periods, impacting their demand and prices. Impact of OPEC on oil futures and oil ETFs. OPEC production agreements. OPEC, Organization of Petroleum Exporting Countries, is a key player in the global oil market. OPEC's decisions to increase or decrease oil production quotas can directly impact oil supply and prices. Changes in OPEC's production agreements can affect the values of oil futures and oil sector ETFs as they respond to supply and demand dynamics. Oil price movements. OPEC's actions can lead to substantial shifts in oil prices. These price movements can directly influence the profits or profitability of oil futures contracts and the performance of oil sector ETFs. Traders and investors closely monitor OPEC's decisions and their effects on the oil market to make informed trading decisions. Overall, wars and OPEC decisions have had a direct and significant impact on the oil market, leading to fluctuations in oil futures and oil sector ETFs, making it crucial for traders and investors to stay informed and adapt their strategies accordingly. Pros: leverage for potential profit, effective hedging tool, high liquidity in the market. Cons: high risk due to leverage, complexity requiring a deep understanding, potential for margin calls, possibility of physical delivery. Oil sector ETFs. The definition of oil sector ETFs are exchange traded funds that track the performance of a specific segment in the oil industry, offering investors exposure to the sector without owning individual stocks. Key features: diversification, provide diversified exposure within the oil sector, spreading risk. Liquidity, easily tradable on the stock exchanges. Expense ratios, typically have lower expenses compared to actively managed funds. Pros: diversification reduces risk, high liquidity for easy trading, lower cost compared to other investment options, potential for dividend payments. Cons: limited individual stock influence, subject to overall market fluctuations, possibility of tracking errors affecting returns. Risk-reward compensation. Factors considered: leverage, which amplifies both potential profits and losses in oil futures. Price volatility, with oil futures being more susceptible to rapid price swings. Potential for higher returns in oil futures if market movements align with the trader's position. Diversification in oil sector ETFs, which spreads risk across multiple stocks. The importance of risk management strategies for both investment options. The trade. Strategy A, oil futures. Entry. The Pajama Trader enters the oil futures market by purchasing 2 crude oil futures contracts at $70 per barrel, each contract representing 1,000 barrels. Over the trading period, the oil prices experienced significant fluctuations due to the geopolitical tensions and supply disruptions caused by war in major oil-producing regions. The Pajama Trader actively manages their positions using technical analysis and market news to make decisions. Oil futures exit. The Pajama Trader decides to exit the oil positions after a 3-month holding period. After the time of exit, the price of oil has risen to $80 per barrel. Total profit for the 2 contracts is $20,000, $10 price increase per barrel, 2 contracts at 1,000 barrels per contract. Strategy B, oil sector ETFs. Entry. The Pajama Trader enters the oil sector ETF market by buying shares of an oil sector ETF that tracks the performance of oil companies and major oil companies. They allocate a portion of their portfolio to this ETF, seeking diversified exposure to the oil sector. Over the same trading period, the ETF provides a more stable performance compared to the oil futures due to diversification. Oil sector ETFs exit. The Pajama Trader decides to exit their oil sector ETF position after the same 3-month trading period. The ETF has experienced a 5% increase in the value during this time. The trader's initial investment of $50,000 has now grown to $52,500. Evaluation of risk-adjusted returns. The Pajama Trader assesses the outcome of both strategies, considering total profit and loss for each strategy, the volatility and risk exposure experienced during the trading period, overall performance compared to their risk tolerance and investment goals. The trader assesses the exit positions compared to the profit generating from the oil futures with the same stable yet moderate gains from the oil sector ETFs. We highlighted the impact of wars on the oil markets, stocks, and futures. Explored definitions, key features, pros and cons of oil futures and oil sector ETFs. Conducted a risk-reward comparison examining factors like leverage, volatility, and returns. Presented a trade featuring the Pajama Trader for practical insights. Become a more empowered trader or investor. It's your turn to take the helm. Craft your investment strategy based on your unique circumstances. Remember, your risk tolerance, experience, and personal goals should shape your decisions. We're not just a video, we're a community. Share your thoughts, questions, and feedback in the comment section. If you found this content valuable, don't forget to hit the like button. Share it with fellow investors and traders. And for more insightful content like this, consider subscribing. We're here to shorten your learning curve in the markets and help in your financial journey. Thanks again for watching.